So dear students, I welcome you all in today's live session. I welcome you all in today's live session, day 2 of AAA webinar series, live revision series. And we were discussing the key conceptual areas. As far as the practice is concerned, tomorrow's session, which will be a longer session, a lengthier session, will be solely for practice, because we will cover all the conceptual areas beforehand. Conceptual areas are very important because until and unless you know these areas well, you cannot do good when you are attempting the real exam scenarios or questions. Okay. So we discussed ethical consideration, professional ethical consideration, quality management considerations yesterday. Acceptance considerations. Acceptance consideration is very important. And when we will be attempting the questions, I'll be telling you that how much important it is, how frequently it is tested. Audit acceptance considerations as well, non-audit related acceptance considerations as well. We will be looking at this area specifically when we will be starting the discussion of non-audit areas, non-audit assignments. We discussed about, okay. So I believe that when we were discussing engagement performance, when we started the discussion of engagement performance or so, I was so tired and I was feeling very sleepy. So I cannot even recall what we discussed yesterday. So apologies for that. And I will quickly go through this and then I'll move forward. Okay. So when the question is examined from the quality management area, this is usually the focus of examiner to test from engagement performance. And there are 3 key aspects of engagement performance: direction, supervision, and review. Direction, simply directing the team members, which areas to focus, which are the risky areas, what they should perform, who will perform which area, what procedures will be performed, and things like that. Okay. So informing the team members of the responsibility to contribute to the quality, which procedures perform, professional skepticism should be applied, things like that. Then comes supervision. Supervision is basically tracking the progress throughout the audit work. If team members are doing the audit work, obviously a senior person, a job in charge, a supervisor will be looking after their activities. If they encounter any problem, if they face any issue, then the person responsible for supervision is the one who basically resolves the ground level problem. If there are any contentious matters or the matters that require consultation or the matters that needs escalation to the senior management or partner level, then the supervision stage should be strong enough to do so. Okay. So tracking the progress, considering the competence of the team, guiding them, addressing the significant matters, and identifying the matters for consultation as well. Okay. And then the person responsible for the review. And I told you that the person who is finally responsible for the review, the ultimate responsibility lies with the engagement partner, the one who is signing the audit report. But the review, for the very first principle, that review should be done by a senior person. For example, the work of a junior cannot be reviewed by the junior staff. It should be senior staff. Then the review should be done by an experienced person, for example, senior manager, and the final review of partner should always be there because he's the one who is responsible for signing the audit report. So checking the audit work to ensure that the audit work has been performed according to the standards, appropriate consultations have been taken place, the documents, the evidences, the procedures are addressing the risks in the relevant assertions, the evidence obtained is sufficient, and appropriate to support the audit report. Then the question on quality management, may contain any of these problems. Okay. So when we are discussing the technique, see, this is the exam technique. This is the exam focus. This is the exam technique of the quality management areas. When we will be attempting the questions, hopefully tomorrow, because today we will be doing the conceptual revision. When we will be attempting the exam questions, specifically relating to quality management, then you'll see that many aspects could be highlighted by the examiner. And you have to obviously make comments on it, on the problems which are there relating to the quality. And students tend to miss key areas. So how can you remember that which are the key areas which need your comment, proper comment, so that you can score marks? If you write one valid justifiable comment, if you identify one valid justifiable issue which you have drafted well, you're going to get 1 full mark. And if you're writing a point, 3 lines, 3.5 lines are enough or should be enough to score a mark. 3 to 4 lines, make it maximum 4, or 3.5 lines are enough to secure a mark. Even if you can describe properly in 2 lines, because obviously now the line could differ, because if you expand the screen, the line could be prolonged. So even if you write 2 lines and you have made your point, you have made a valid point, you're going to get 1 mark. Okay. So a common requirement in the exam is to critically evaluate the audit work already performed on an engagement and identify if the audit has been carried out to the required standard of the quality. So first of all, you should assess that whether is it a hot review or a cold review, because hot review is the one which is done before the audit. There could be quality level problems before the audit report has been signed. Hot review. Cold review after the audit report. Okay. So have the requirements of ISRs been followed? Have the work been allocated to appropriate level of staff? Obviously, the technical work should have been delegated to this senior staff, experienced staff, not to a junior staff. Is audit subject to any time pressure? If there is any time pressure, the quality could be compromised. Has the appropriate relevant evidence obtained? Has the plan been followed? Has it been properly supervised? And when we say is the engagement properly supervised, because if there are indications in the question that there has been no ongoing monitoring, that there has been no check and balance on the audit team, matters might not have been escalated for consultation, then this simply means that there are indications that audit is not properly supervised. Has the work been properly reviewed? Reviewing working paper file. Whenever you see this written anywhere, it means sufficient and appropriate audit evidence. SAA, sufficient and appropriate audit evidence. Is it on file? Proper documentation. Has the working papers been completed? Have relevant communications been made? Engagement quality reviewer, those charged with governance. Has an EQR been performed where required? Listed other high-risk clients. Has the engagement partner given sufficient time to properly review the significant matters and judgments to be able to form a conclusion? Have matters that are required to be documented have been documented? So these are all key aspects which you need to be particular about. Okay. Issues to consider prior to accepting an engagement. Okay, this is a brief one and this is the detailed one. I've already discussed it yesterday. I've discussed it quickly yesterday because very easy points. These are very easy points. These are very self-explanatory points. And we should rather spend time on attempting it tomorrow rather than further discussing it, because these are easy points but very important. As I've already told you that this is one of the frequently asked question in your AAA exam. Okay, then now moving on towards today's discussion. Phases of the audit. So if we talk about the phases of the audit, we have three broad phases. First one is planning the audit. That's the planning phase, where we do risk assessment. There are various aspects, including risk assessment. Very important. In every exam setting, you're going to see a question from the risk assessment. It could be audit risk plus business risk, or only audit risk, if not business risk, because business risk is usually tested once in every 2 attempts, is an estimation, once in every 2 attempts. And audit risk is a regular feature of every attempt. Okay, so usually both of these in combination make 25% of your exam paper. Such an important area. Such an important area. Conduct of the audit, actually performing the audit, actually testing the transaction, testing phase. We can also call it testing phase, where we perform substantive procedures. Accounting standards knowledge is must, is very, very important. We perform audit evidences, we perform audit tests. And then there is a completion and finalization review phase, where we finally review whatever has been done, including final analytical procedure, and issuing opinion and opinion related implications. So audit strategy and planning is very important. This is very straightforward. You can go through it on your own. Strategy: when to deploy the resources, when meetings should be conducted, how things should go on, a specific audit plan, which areas to target, which procedures to perform on which area, who should do these. So strategy is a broader strategy. For example, if a team is going to play cricket, either the strategy should be defensive, attacking. And when we talk about plan, so it's a detailed plan, how to play a particular bowler, how to target a particular batsman, how to target a particular delivery, where to place the fielders. Specific plan. Okay. And the most important part of your syllabus comes up, and that's risk assessment. Risk assessment. Now, what do we mean by risk? Risk simply means chances, probability, or apprehension of something going wrong. This is a risk. Apprehension of something going wrong. What could go wrong in a business? That's a business risk. What could go wrong in a business? That's a business risk. So if we remove audit for a few minutes, if we set aside the audit related discussion for a few minutes, is business risk a technical area, a technical topic of discussion? I said no. Business risk is a layman's discussion, is a businessman's discussion. Okay, so business risk, what could go wrong in a business? A businessman is all the time concerned about what could go wrong in a business. Not a big deal. If we set aside audit related discussion for a few minutes, so we can say this has nothing to do with audit. Business risk exists in every business, whether we audit or not. Simple. So students confuse these two. You do not need to confuse. Business risk even exists if an entity is not auditing anything, if an entity is not getting their operations audited, if you are not auditing that entity. Even then, the business risk exists. What could go wrong with the business? For example, sales could decline, competitor pressure, product can get obsolete, my sales can go down, there could be embezzlement in cash. Are you getting this? Many areas. There could be flood and my data center can destroy. Business risk. My data could be lost. Business risk. I'm spending a lot of money on overhauling of an asset. There could be cash shortfall. If there will be cash shortfall, my business could stuck up in operations. So anything which is denting a business is a business risk. And usually, if you want to trace or track a business risk, you have to see whether is it affecting your sales revenue, is it affecting your cash flow position, is it affecting your profits. So if anything is affecting revenue, cash, or profits, generally it is said that it is a business risk. Even an entity gets things audited or not, business risk is there. And every entrepreneur, every business owner is concerned about business risk. What could go wrong in the business? So why are we studying it in the audit? Are we going to study business risk? Are we going to study business? Are we here to do any business? I said, no, we're not here to do any business. But until and unless we can understand, until and unless we understand the relevant business risk of the company which we are auditing, we might not be able to identify the audit risk properly. So in order to help us identify audit risk, we take the help of business risk. We plan initially, we understand the business, we take understanding of the business, we perform few analytical procedures, and we analyze the business, that what could go wrong in the business. What could go wrong in the business? What could go wrong in the business? And then with the help of that, we conclude what could be the audit risk. Simple. Okay. So in order to comply with ISAs, auditors are required to design procedures to reduce risks. Okay, first read this. Auditor will use this understanding to assess the risk and design further audit procedures in response to these risks. So we identify business risk, then we think what could be the audit risk, and then we design the procedures. Business risks include all those factors that threat clients' ability to meet their strategic objectives, namely profit targets. So business risks include all those factors that threaten a client's ability to meet. These are important part of inherent risk assessment because they also have potential impact on financial statements, profits, revenues, cash flows, future ability to continue as a going concern, as I already told you. And what is the audit risk? Audit risk is what could go wrong in the financial statements. Risk of material misstatement. Audit risk is comprised of two things. What could go wrong in the financial statements, which is called risk of material misstatements, and our ability to detect it. If we are not able to detect it, that's the detection risk. If financial statements contain an error, that's financial statement risk. We are unable to identify it on account of our poor procedures, incompetent team, incorrect timing. There could be a possibility that we might not be able to detect it. That's detection risk. So this risk is of financial statement side, related to management, related to inherent and control risk, and this relates to the auditor. Okay. So see, risk of material misstatement is a factor of inherent risk and control risk. Material misstatement. Inherent risk, the risk that fraud or error occur in the first instance. By default, this is attached to every assertion. Inherent risk. The default risk attached to any assertion, not every, my bad, to any assertion. For example, financial instruments. The default risk of wrong valuation is attached. Why? Because it's complex. It's complex. Getting this? Bad debts, impairment, inherent risk. Why? It involves judgment. Control risk, the risk that client controls fail to prevent or detect fraud or error. Control lapses could be there. Again, this is a client side. And if that happens, financial statements figures may be wrong. And that's called risk of material misstatement. Inherent risk plus control risk. If you combine them, it's called risk of material misstatement, or it is called financial statement risk, because this is the risk in the financial statements that the errors might have entered into the financial statements. Errors might have attacked the financial statements. Errors are going to attack the financial statement. There should be a wall of control in between, but there is no wall of control, and or the wall has been compromised, or the error have bypassed the wall and entered into the financial statement. So this risk in combination is called financial statement risk. And what if auditor is also unable to detect it? That's detection risk. Are you getting this? So that means there are two walls standing before it enters into the financial statements. There are two walls. And then here is the financial statement, two walls. So error is coming, comes the first wall. Control lapses occur. Oh, it has passed. Control lapses. Then another wall. That's called the detection wall of detection. Auditor's wall of detection. But this is also weak. Not strong staff, not experienced staff, not knowledgeable staff, procedures not well planned, things like that. Errors also bypass this wall, then it will enter into financial statements. But in our hand, in the hands of auditor, there is only one wall, detection risk. Getting? Top-down approach we've already discussed. We first identify the business risk, and then we identify the impact on the financial statements. Business risk means anything company failing to meet its objective, and how and why things could go wrong in the business. Are you getting this? Okay, so dear students, so this is the screen which I have kept open for you, and here I am simply writing that it's break. Because it's prayers time here in Karachi. So I'll be going on a short prayers break, I've mentioned here. But you are reading this slide. You are going through this slide, okay? And once I'm back, I'll be discussing this. So you are going through this, you are reading this, and then once we are back from the break, we'll be discussing this. So you can also take a break. Okay. Welcome back. We were having the discussion relating to business risk and financial statement risk. And we discussed a very important aspect that in a top-down approach, identifying business risk, which will obviously be identified through proper understanding of the entity. Identifying the business risk will eventually help you in identifying financial statement risk. This is called top-down approach. Even in your exam question, you'll see the first requirement to identify business risk and then to link that business risk with the financial statement risk. This is how it goes. Okay? And now you know what's a business risk. We've already discussed. Anything which is impacting business, anything which is hindering business. And this is a pain point of a business owner. You have to think like a business owner. You have to think like a CEO. That what could impact my business? How my business could be impacted? And you have to think from 3 or 4 aspects. Is anything hindering my cash inflows? Is there anything which is impacting my revenues, or is there anything impacting my profits? These are not before financial statement indicators, these are business indicators. So for business risk, we have to see the business indicators going green. We are at the moment when we are discussing business risk, we are not concerned about the financial statement problems. What could go wrong in the financial statements? That's the next step. First of all, you have to ascertain and assess that what could go wrong with the business. Is there anything which is stopping my cash flows? Is there anything where my cash could be stuck? I could be hand to mouth because cash is the running blood of the business. Is there anything which may impact my revenues? Tough competition, prices going down, old products, many things. Okay. So these are the few examples how a particular event can be linked first with the business risk and then with the financial statement risk. A major customer is in financial difficulty and may be unable to pay their debts. So what's the business risk? The business risk is if the customer is unable to pay the debts, I have to write it off. My profits will go down. Profit going down is a business problem. Before a financial statement problem, this is a business problem. Okay. If that customer won't turn up, it won't pay me. My cash inflows are gone. My expected cash inflows are gone. I could face cash flow difficulty. If that customer is turning bad, it will not generate future revenues. So can you see? A single event, but we can explain it from 3 aspects because all 3 business indicators are going red. Because if a customer is struggling to pay the debts, number 1, we may need to write it off. It'll go in P&L, expense will go in P&L, profit will go down. It will not pay me. That customer will not pay me. If that customer will not pay me, my cash inflows, I might face cash flow difficulties. Number 3, my future sales will be no more from that customer. My future revenues are impacted. All 3 indicators turning green. And I'm able to link this event with all 3 indicators. And even the 4th one. If this customer is such a big customer of mine that my 90 or 80% sales are to this customer only, then if this customer is going bad, my business can be shut down. I might face going concern problem. That's again the 4th business risk. Or the 4th aspect of the business risk. Are you getting this? So this is the business risk, and I've further explained it to you. How could it impact financial statements? How could it impact financial statements? Now see, if receivable is going bad, what do I need to do when a debt goes bad? IS says, if it needs provision, do the provision. If it needs write-off, do the write-off. And if the write-off is not done in the financial statements, the financial statements may be wrong. Now that's the point where I'm concerned about the financial statements. And this financial impact has been guided by the business risk. So business risk has enabled me to reach this. Are you getting this? This is called top-down approach. Another example. Company purchases goods from overseas. This is an information, this is an event which is given to you in the question. The company purchases goods from overseas. A student may think, so what? A lot. Not so what. There is a lot in it. What is in it? Business risk. Very important business risk. Don't think of the standard relating to exchange rate fluctuations, foreign currencies. No, don't think about it in the first phase. What could be the business risk? What if the foreign exchange goes against the company? Foreign exchange rate goes against the company. What if the adverse FX fluctuation is faced by the company? Will the company be concerned about translating the amount? Will the company be concerned about whether my gain will go in P&L or OCI? No. Company will not first think about this. Company first of all will think about that if the exchange rate is going adverse, I will be required to pay more in my local currency. I will be required to pay more in my local currency, and the goods which I am purchasing will become expensive because I need to pay more. Are you getting this? So this is the problem of a business. This is the business problem in which we are not talking about any IAS, we are not talking about any IFRS. But yes, when we link this problem with the accounting standard, we will talk about IFRS. We'll talk about IAS. We'll talk about the foreign currency standard. Are you getting this? So if you talk about the business risk, exchange rate, companies purchase goods from overseas. What could be the business risk? The business risk could be if the foreign exchange fluctuation goes against my favor, is not in my favor, if I am facing adverse fluctuation of foreign currencies involved, then I will be required to pay more cash for the purchases. Impact on cash flows. Getting this? My purchase cost will be higher, expense will be higher, impact on profits. And if my purchase cost will increase, and if suppose I increase my selling price, my customers might be lost. I might not be able to sell it. It may impact my future revenues. So a single event linked to 3 different aspects of business risk. Are you getting this? This is how you're going to explain in the exam as well. Until and unless you link your explanation with the cash flows, profits, revenues, going concern problem, your business risk is incomplete. You have to link your business risk with these elements, with these 4 factors. Then you can justify your business risk only, otherwise not. Are you crystal clear about that? Then in the next phase, as a next step, that business risk will impact on the financial statements. So now you have to think, which accounting standards might be violated? The next phase, the next step, which accounting standard might be violated? Are you getting this? So now you have to think. The foreign currencies accounting standards ask us that the transactions for the year we should translate using the average exchange rate or the date of transaction. For the transactional, for P&L, for purchases, we need to use the date of transaction if it is being settled. And suppose if it's a payable, then we need to use the balance sheet date to revalue it. Isn't it? The purchases may be misstated if transactions are not translated using an appropriate exchange rate. The purchases will need to be recognized on the date of purchase, exchange rate prevailing on the date of purchase. But the liability, the related liability, it will be revalued because it's outstanding at the year end. So at every year end, we need to reprice it. We need to revalue it. And if this is not done correctly, if this is not done using correct exchange rates, my numbers in the financial statements may be misstated. That's my second concern. So the first concern is the business concern. The second concern is the financial statement concern. Are you getting this? The first problem will lead to the second problem. Is everyone with me? Is everyone crystal clear on this? Because one of my student who once secured in 70s, he secured 74 in AAA. But when he attempted the mock exam, I can recall his mistake. He confused in business risk and audit risk. He wrote business risk in audit risk. And when rectified, obviously, before going to the examination, that point or that issue was rectified, identified, and he scored 74 marks in examination. So even good students do mistakes sometimes on account of lack of clarity. Are you getting this? So can you please confirm me that this concept is crystal clear to all of you? Dear students, can you please confirm me? Please acknowledge that these two concepts are crystal clear to you. Good. Great. Okay. The third example. Changes in laws and change in laws and regulations affecting the company. If the laws and regulations have been changed, this is the information given to you in the exam. What could go wrong? You may fail to follow the revised law, the new law. You may fail to make the compliance. If I fail to make the compliance, what could impact? What business indicator could be impacted? What business indicator could be impacted? Number one. Okay, so we are currently looking at this one. Okay. We are currently looking at this one. So, first of all, I need to think, what could impact my business if the laws have changed? What could impact my business? If the laws have changed, I might fail to comply with those laws and I might commit non-compliance. Simple. What if I commit non-compliance? Is this a business risk? Yes, this is a business risk. If I write this, the company may fail to comply with the new laws and regulations. Is this a business risk? Yes, this is a business risk. Will the student get the full marks? No, student will not get full marks. Why? Because you have not explained it. You have not explained it. What is left in explanation? As I told you, you have to link it with the business indicators. You have to link it with the business indicators. What are the business indicators? Cash, revenue, profits, going concern. So in most of the cases, obviously going concern is a special case. So at least these three are very simple indicators and these will be impacted in most of the business risks. So let us think how could this impact my profit? Number one, if I fail to comply the laws and regulation, the regulatory authorities may impose fine on my company. And what is a fine? A fine is an expense. If the fine is an expense, my profit will go down. Business indicator going red. So I've thought and I've explained one aspect. Number two, if I will be required to pay fines and penalties, if these will be significant fines, then obviously my cash will go. I will be having cash outflow. My cash flow will be stuck. Number three, revenue. Can it impact my revenues? I cannot think of it. I cannot think of it. I cannot think of it. Oh, yes. If you focus, you can think of it. How? If I do non-compliance, my customers will see I'm a non-compliant person. If this non-compliance is known to my customers, in market in general, then my customers might say that why to purchase with this non-compliant person? My reputation can be damaged. My reputation can be damaged. And I can lose my customers. If I lose my customers, my revenue could be sliced up. Problem. So this problem, I've managed to explain this problem from three aspects: impacting profits, impacting cash flows, and impacting revenues. Yes. And now, how it will impact in financial statements? See, if there are unrecorded provisions, if the fine is likely, it's probable, amount could be reliably certain, then IAS 37 say there is a past obligating event is established. If you can estimate the amount and event is, the outflow is probable, all three indicators, all three conditions are met, you have to record the expense and the liability. So what's the financial statement risk? The financial statement risk is that this penalty, this fine, this may not be booked in the financial statements as per the requirement of the law, as per the requirement of IAS 37. That's the problem. Okay, so participants are annotating on my screen. Is there any specific reason? Is there any specific reason that some students are disturbing? Okay. Okay, Saqib. So I think you joined a bit late. I've already explained this question. So Saqib has a good question, but I've already explained this. Let me re-explain this. Saqib is asking that I told that business risk has nothing to do with the financial statement. Okay. So when I was explaining this, I told that these three elements, cash, profit, and revenue, although all these three elements, you can find it in the financial statements. Simple. You can find cash in the balance sheet, profit in P&L, revenue in P&L. You can find these. But before being financial statement elements, these are business indicators in the first place. Are you getting this? Even if you go to a hawker, even if you go to a small shop who might not be conversant with the financial statements concept, who might not be creating a balance sheet or P&L, if you talk about profit, he will recognize the profit indicator. If you ask, is your business profitable? He will say yes or no. Why? because he is not a chartered accountant. He has not studied accounting anywhere. Why is he answering that my business is profitable? How does he understand profit? Okay, if you ask him, I'm purchasing this product, he'll say, pay me the cash. Oh, cash is a financial statement indicator. How he knows what is cash? He knows about cash inflows and outflows. Isn't it? If you talk about turnover, is your sales going good? He'll answer yes or no. He may say that the conditions are tough, the sale is going down these months, or the sale is good. How he is understanding sale? He is not an accountant. He might not be literate, but still he is understanding these terminologies: cash, profit, revenue. So these three, before being financial statement elements, these are the business indicators which a common man can discuss, which a layman can understand. Are you getting this? So these are the business indicators in the first place. Then, yes, these are the financial statement elements. Therefore, we are saying that when you understand the risks to these business indicators, you might be in a better position to identify the problem in the financial statements caused by these business indicators getting red. Are you clear, Sakib? So, in the very first place, these are business indicators. So, we have to explain the business risk as if something disturbing these business indicators. And then we can easily identify the impact in the financial statements. Getting? This is a very important concept, okay? And we have spent sufficient time on it. Okay. Then let's look at another example. This one. Sales have decreased significantly and the company is closing number of sites. You find this information in the question. You find this information in the questions. Sales have decreased significantly. Company is closing a number of sites. So this information is speaking loud about the business risks. Screaming. This information is automatically screaming itself about the business risk. Sales have decreased. Sales have decreased. The business indicator going red. Getting? Company is closing number of sites. Sales getting decreasing. Cash inflow will also decrease. And sales decrease. The decrease in sales, decrease in turnover will impact profit. Decrease in profit, impact on cash flows. What is the impact, or what could be the impact on the financial statements? If my sites are getting closed, if my sales are decreasing, so don't you think that assets which are responsible to generate those cash flows, those assets might be impaired as well? Because how I am calculating impairment of an asset? Don't you think that recoverable amount of an asset is generated by estimating future cash flows? The value in use. Are you getting this? Recoverable amount. Higher of 2. Fair value less cost to sell. Value in use. Value in use. How I calculate value in use? Value in use is calculated by estimating future cash flows. If those cash flows are down, if the sales are down, my assets might be impaired. And IAS 36 says this is an indication of impairment. Test your assets for impairment. Getting this? Fall in demand of product, falling sales, reducing profits, reducing cash flows. Inventory, lower of cost or NRV. My inventory might be overstated. My assets might be overstated, which are producing that inventory, which is now reducing in sales. My asset could be impaired, tested for impairment. Court case, very, very interesting. Court case going on. A court case can be linked with all business indicators. If the case outcome comes against you, it could be an expense. It will be an expense. Expense reducing profits. If the decision comes against you and you have to make the payment, cash outflow. Cash is stuck. Cash problems could be there, could arise because if there is a cash outflow, there is a pressure on your cash reserves. Third one, the decision has come against me. If people will get to know, my reputation will be damaged and I may lose my future customers, reducing the future sales. So all three business indicators going red. What could be the impact in the financial statements? What could be the impact in the financial statements? Now see, we are talking about impact in the financial statements. We talk about IAS 37. We talk about IAS 37. We are not talking about the future revenues being decreased. No. We're not talking about the cash outflows. We have to do it. Those are business indicators. When we talk about financial statements, what could go wrong in the financial statements? IAS 37 comes up. IAS 37 says, potential cash outflow, litigation, which is going to be settled against the customer, against the client, book the provision. Book the provision. Book the expense, book the provision. That's it. If a provision is booked, expense is booked, financial statement says, our problem is solved. Rest is the business problem. We are done and dusted. We are settled. Provision booked, expense booked. That's it. The rest are the business problems. Look at your own self. Are you getting this? Simple as easy as that, straightforward. Nobody should confuse these two. Please let me know if this is crystal clear to all of you. Great. This is again one of the current issues. There could be climate related risks as well. There are questions in the past exam which have touched this aspect. This is not a big deal because climate related events may contribute to risk of material misstatements. There could be laws and regulations to be complied with. This may impact risk of material misstatement in the financial statements. They might hit their assets. Bad weather can result in impairment of the assets. Understand how management identifies those climate related risks, materiality, procedures, and things like that. If you need an expert to test these, use the services of expert. Okay. How the auditor should assess the risk? Obviously, obtaining an understanding, using professional judgment, and performing risk assessment procedures, inquiries, analytical procedures, observation and inspection. Observation and inspection of procedural manuals, SOPs, and things like that, okay? Not audit evidences. It's not inspection of invoices, but the inspection of policy manuals, HR manuals, SOPs, things like that, to gain understanding of the entity. Okay. Another very important concept without which your question number 1 is incomplete. Whenever you talk about the risk of material misstatement in the financial statements, obviously you cannot check or test each and everything. So auditor focuses on materiality. What is a material amount for me? For a multi-million-dollar company, embezzlement of $100 is nothing. Auditor might not be bothered to check that $100 fraud in a multi-million dollar company. It's not material. So materiality is very important, because even if when I'm picking up the transactions for testing, I will see materiality. I will keep materiality in my mind, and then I'll pick the sample for testing. Those sample would include high value items. Are you getting this? Materiality has its role in sample selection as well. So materiality should be in relation to the financial statements as a whole, unique circumstances of the business, information requirements of the user. Benchmarks. There are 3 benchmarks: revenue, PBT, total assets. The good thing is that in question number 1 now, examiner prescribes the benchmark. Earlier, the examiner did not use to prescribe the benchmark in earlier papers a year ago, but now examiner gives you the benchmark, so it's easy for you. You have to use that benchmark, and when you start drafting audit risk, you have to see whether it involves any amount, and if the amount is involved, whether it is material or not. Suppose there is $100,000 profit, and the examiner says that you have to base materiality on profit, and suppose you have identified 5% profit, so $5,000. Are you getting this? You may say 10%. How we decide 5 or 10? If the client is more risky, keep the percentage low so that you can check more. If client is not risky, there are not much risks. You have been auditing in past as well. There are not much risks affecting the business. You may keep 10. It depends upon your risk assessment, your professional judgment. There is no hard and fast rule. You may pick 6, you may pick 7. Simple as easy as that. So, when we will be attempting the question, I'll be telling you how you draft a materiality point. But these are the usual benchmarks which you should keep in your minds. Revenue, it's 0.5 to 1. Assets, 1 to 2. Then PBT, 5 to 10. And then there is a concept of performance materiality to further reduce the misstatement to further reduce the risk of misstatement being ignored. We lower the materiality percentage. We calculate a performance materiality, which is usually 70%, 75% of planning materiality. I'm not delving into this concept, otherwise it will get technical. But this is the materiality for actual testing purposes. And the planning materiality, 5-10% is the overall materiality. Okay. Whenever there is any area for which you foresee any risk, there could be risk in that area, you have to perform, you have to address that risk by performing adequate procedures. You have to address that risk. How can you address that risk? Depute senior staff, increase the test, change the sample size, allocating complexity or complex risky area to suitable experienced staff, placing more or less reliance on systems and controls, altering the volume of the transactions being tested, change sample size, perform more analytical procedures, more or less analytical substantive analytical procedures, and things like that. Professional skepticism, be alert. Use your brain. Questioning attitude, critical thinking, challenging, not accepting every argument or everything on the face of it. Question things, and you'll get to know many things. So these are comparatively easy concepts. Then we have consolidation and group audit aspects. In exam question, there are high chances that you get a question relating to a group of company having multiple subsidiaries, maybe foreign subsidiaries, and there could be many risks. What could be the common risks? What could be the common questions? Let's have a look at it. So if the question talks about a group, you might find a parent company, a subsidiary company, or multiple subsidiaries. And we know, as per the requirements of IFRS, the consolidated financial statements should be prepared. Okay? And the parent auditor also gives opinion on the consolidated financial statements. So the parent company auditor is responsible for the opinion on the group financial statements, which combines the financial statements of all the subsidiaries. And not necessarily all subsidiaries are audited by the same parent company's auditor. There could be different auditors. There could be a subsidiary in the foreign country. We might not have presence there. You might have to use the work of a firm there. There could be problems. That foreign subsidiary's financial statement might not have been prepared as per IFRS. That's again a problem. Those auditors do not understand our communication. There could be language barrier. There could be barrier of expertise. They might not be following what we are saying them to do. Because we are the parent auditors, we have to sign the consolidated financial statements, true and fair view. So we are concerned. But don't you think there are multiple elements or multiple factors which are creating risk? Answer is yes. And there are many others. So let's see a list of this. Consolidation process. In consolidation process, there are multiple elements. Many of these contain risk, carry risk, like net assets, valuation of net assets creates risk. Are you getting this? So think of the consolidation process. If you think of the consolidation process, you will automatically start picking the risks. Net assets, the fair value, how the fair value has been estimated, how the fair value is an area of judgment. How goodwill has been estimated, area of judgment. Audit risk, inherent risk, NCI, profit apportionment, intra-group balances, foreign currencies, many aspects. So group audit considerations. There could be problems in consolidation adjustments. Goodwill calculation may carry risk. Intra-group balances, they need to be knocked off. NCI, if it's on fair value, then fair value of NCI, again, judgment, estimation. Fair value adjustments to the net assets, risk, estimation, uncertainty. Accounting standards, these are accounting standards which are applicable usually. Then component auditors' involvement also creates some fuss. Their competence is a question. Are they capable? Are they ethical? Are they complying with the ethics? Are they understanding our instructions? Greater planning required, because it's a group audit, so greater planning required. The additional aspects will also pop in. How? Decide which components to audit. Might be there could be 15 components, 15 subsidiaries. 3 are very insignificant. We might decide not to audit those. Obtaining understanding of all group companies, setting materiality and performance materiality on the consolidated financial statements. Obviously, it will be. Assessing risk of material misstatement of the group financial statements. Group audit acceptance considerations, these are easy. When the group auditor will be accepting, whether he can find sufficient appropriate audit evidence, no restrictions, preconditions, things like that. And component auditor, the competence, understanding of the framework, willingness, and things like easy discussion, so I'm not spending much time on it. Group audit risk. Yes. Rosemary, yes, you're going to get the slides. I'll be sharing the slides. Once we are done with these, I'll be sharing the slides. Don't worry about that. Group audit risk and responses to the assessed risks. So I've already enumerated and listed many risks. So this is a list in which you'll find almost all the risks which are usually appearing whenever there is a question of group audit. Valuation of goodwill, translation of foreign subsidiaries, inconsistent accounting policies of parent and subsidiary. So adjustments need to be made, and this creates risk. Fair value adjustments, calculation of NCI, changes in group structure, intra-group balances, and trade. Control risk relating to consolidation process. If that process goes wrong, number go wrong. Detection risks where the component auditors are involved. Obviously, there is a detection risk because we are not auditing those components. If the component auditors, subsidiary auditors are different, we are not auditing those numbers, there is a detection risk. Those component auditors might be incompetent. They have not looked at the numbers. And we may end up consolidating wrong numbers. So detection risk increases. How should these be responded? Ensuring many things. Ensuring that all entities have been included, evaluate whether the adjustments reflect the events, management judgment, risk of material misstatement or due to fraud and things like that. Group audit completion, these are administrative aspects. You can read on your own. Okay. Group reporting aspect. We will discuss this slide. Just remind me that I've left this slide and we can discuss it later when we are discussing the opinion related aspect. Okay. Audit evidence and procedure. Sufficient, appropriate evidence. Those should be relevant, reliable. Okay. So this is a very important slide. We've identified the risk assessment, business risk, audit risk. What's the next step? Testing the transactions. Actually testing the transactions. How are we going to test the transactions? We need to know audit procedures. The question can ask about the audit procedures. What audit procedures you are going to perform? Or alternatively, the question can ask what audit evidence you expect to find in your audit working paper filing. Although apparently these two questions looked different, but in actual these two questions are same. Because procedure is nothing but just a action-filled transformation of the audit evidence. Simple. Document, invoice is an audit evidence. But if we think of the invoice, what could be the audit procedure? Check it. Inspect it. Inspection is the audit procedure. Inspecting the invoice. So if you can think of the inspection, you can think of the invoice. Inspect the invoice, inspect the gate pass, inspect the sales invoice, inspect the whatever inspection you need to do. Are you getting this? Okay. So audit procedures, if you can recall audit procedures, these will help you in writing audit evidences. If you recall audit evidence, these can help you in drafting audit procedures. Because these two are twin brothers. Okay. So AEIOU, so the Technique to remember these procedures: A, E, I, O. Take the U from here. Analytical procedures: ratio analysis, comparisons, inquiry, confirmation, inquiry from management, confirmation from debtors, creditors, tax, law, lawyers, tax experts, inquiring from third party confirmation. In audit evidence, you'll also find third party confirmations. From inquiry or from confirmation, you can land on to the confirmation. Inspection, documents, observation, recalculation. Okay, so this is the list: A, E, I, O, U, very simple to remember. Then audit evidences. What could be the audit evidences? SAD 3. Remember this. SAD 3. S means subsequent events. This also sometimes gives you the evidence. Subsequent sale of an inventory item. If it's below the cost, do it lower than cost or NRV at year end. So subsequent event is giving the indication what its value could be on the year end. A2, accounting records. From here as well, you jumped onto the accounting records, source documents, etc. Asset inspection. Asset should be physically verified. Physical verification. So inspection of asset. A2, accounting records, assets inspection. D2, directors documents. Okay, representation of BOD directors representation to be taken. BOD minutes you have to take, you have to file, you have to read. Third party confirmation already derived from here. So there are many procedures which will help you in identifying this. Are you getting this? And if you recall this list, then there are evidences. This will help you in recalling the procedures. So remember both of these lists. Related party transaction. This is an easy standard you can go through on your own. I'll share these slides. Why the standard focus on related party transaction? Because there could be risk of transactions being carried out at non-arm's length basis, or it might not have been properly disclosed. What could be the procedures? Reviewing accounting records, reviewing unusual transactions, bank confirmations, invoices, lawyers' correspondence, board of director minutes, who is the company in which we are investing, register of shareholders, inquiry of management, and things like that. Then we can also use the work of expert if something goes out of our control. For example, the valuation of oil rigs, you might need to use the services of expert who has specialist skill, knowledge, and experience, and that expert should represent us, should gather sufficient appropriate audit evidence, agree which expert to use, consider competence, capability, objectivity, ethics, all criteria, agree the nature and scope, and assess the expert's work. Skill experience is very necessary, and you have to assess the expert's work, because the findings of expert will lead you to write the opinion. Are you getting this? Internal audit, you can use the internal audit team, their work, their reports, their findings for your work. You can ask them to provide direct assistance. Easy. Using service organization. What do we mean by service organization? For example, if a company is providing payroll processing service and your client is taking the services from the payroll processing company, then how can we check what that payroll processing company is processing? Until and unless we see their system, we take the source files and things like that. Are you getting this? So using the work of service organization, if third company is calculating my payroll, if third company is calculating my taxes, things like that. So being auditor, I have to check few things in order to get the reliance. Are you getting this? Using different reports and things like that. Accounting estimates, where the judgments are involved, estimations are involved. Then to change the value, you have to accounting estimates, judgments, estimates, and the areas which are subject to judgment and estimate, there is inherent risk of a wrong amount being put into the system, because judgment cannot be questioned, or if it can be questioned, the counterparty can say, this is my judgment, I know the business better than you, so we cannot talk much on it. Are you getting this? Okay. So I think there has been, okay, I think the wrong heading has been placed here. Okay, so there has been a shift of headings, so apologies for that. The use of service organization heading should go down, and this estimates heading should go up. Okay, so I hope you can understand this adjustment. Okay, so this, although I didn't read this, I explained you generally. So if this relates to the estimates, so estimates contain inherent risk because estimation is involved, complexity, subjectivity is involved. So these procedures are very important. Read these, that you have to review subsequent events, what are the results of those estimates, how the management has made their estimates, develop a point estimate and compare to the management. So develop your self estimate, compare with the management estimate, obtain written representation. This comes up very frequently. Okay, tested in multiple areas. And then service organization, if your client, for example, is taking services from another organization, for example, payroll processing, so how can we go and check their processes? So what do? We take the reports. There are two types of reports, type 1 report and type 2 report from the service organization. Okay, if you think that their controls are expected to operate effectively, take the type 2 reports. Take or obtain type 2 report. So you can go and read that what each report contains. Okay, so that's not a big deal. Again, this is easy. I've already told you that you have to shuffle the headings, because the work of service organization is not this. This is the work of service organization. Getting this? Opening balances, if it's a new client, the auditor must ensure, even if it's not a new client, you must ensure that balances not contain material misstatement, accounting policies have been consistently applied, comparatives agreed to the prior financial statements, automated tools are there, you can use them in your audits, easy discussion, you already know this. Okay, we've already discussed the exam technique of ethical threats, we've already discussed this. This is the exam technique of business risk, that you have to identify the information in the scenario which is creating the risk, and you have to link it with the business operations, And in operations, there are 3 business indicators I've already explained you. Then this is the exam technique of risk of material misstatement. This is very, very important. Reliance on expert and internal audit, similar in certain aspects, but in internal auditing, you can use their work. You can use their work to reduce your testing. But if it's an expert, obviously, the work of expert will not help you to reduce your testing, because they are providing you reliance on some result or some element which you are unable to do. In internal auditing, obviously you can test those transactions, but you are reducing your burden. Rosemary, I think your point is clear. Exam technique, risk of material misstatement, very interesting. Exam technique is very interesting. And we'll discuss this, and we will call off today's session, and then we will start our practice from tomorrow's session. Tomorrow we are going to look at multiple questions, preferably from last 2-3 attempts, the recent ones. So especially question number 1 of last 3-4 attempts. We'll try to. Okay. Exam technique of risk of material misstatement is very important and is in front of you. So what this says, when you're writing risk of material misstatement, you're most likely to get 3 or 3.5 maximum marks maximum 3.5 mark for a risk. But there are certain risks for which examiner gives you additional information, and additional information could be used to write multiple aspects of that risk. So those juicy risks might contain more marks as exception, but usually 3.5 marks, 3 marks, not more than 3 you find in any risk usually. And in exceptional circumstances, you can even score 4-5 marks if more information is given relating to a particular risk. So what should be your approach? If numbers are there, calculate materiality in the very first place and let the examiner know, is this material or not? Is this material or not? Then you have to identify that which financial statement area is under the risk. Is it inventories? Is it asset valuation? What is this? What is the area under the risk? Number 1. And then you can also say that, is it inherent risk or control risk or whatsoever? So areas like inventory, intangibles, etc. So which area and how? Is it wrong classification, wrong valuation, wrong estimate, wrong? If you can write this. So you're going to get half mark for this area identification. Getting this? State the required accounting treatment. For example, the directors have not done the impairment testing. So what's the actual accounting requirement? State the accounting requirement and then apply it onto the scenario. The directors have done wrong. In light of the IFRS, this is the requirement. Directors have not applied the treatment correctly. So accounting requirements and application to the scenario, half mark, a half mark. But again, in juicy risks, this could contain 2-3 marks. This could in combination may fetch you 2-3 marks. And this will be very clear from the question, because in question you will be given the content. If there is a lot of content on a single risk, that simply means the examiner is interested in asking more from this. If the numbers are given, if the ratios are given, calculate analytical procedures. If the numbers are given, calculate few ratios to interpret in relation to the context of the question, information given to you in the question. and then impact, risk of overstatement or understatement. If the bad debts have not been recognized, what is overstated, what is understated, impairment not recognized, expense understated, assets overstated, things like that. Which ratios? These are the ratios which are important. Are you getting this? So tomorrow we will start by attempting question number 1. We'll try to look 2-3 question number 1s. I think that should be enough for you. And then we'll move on to question number 2 and question number 3. Okay? So let's keep the session till here, because before I feel more sleepy. So tomorrow the session will start at 5 p.m. as per Pakistan Standard Time, and the session will be for 4.5 hours with 2 breaks of prayers. Okay, so see you tomorrow with practice, especially the recent attempt paper. We will be interested in last 2-3 recent attempts. So if you get the chance and get the time to read question number 1 of last 2-3 attempts, do go through it, and we will be attempting tomorrow. Okay, so thank you very much. Thank you, students, for your involvement, for your active participation. May Almighty bless you all. Take care a lot. See you tomorrow. With Yoda signing off. Bye bye. Allah Hafiz.